Okay, hello Internet and welcome back to AGXM. Today's guest is Dan Oliver, founder of the popular newsletter Myrmikan Capital. He's also the president of the Committee for Monetary Research and Education. Dan, thank you so much for joining us. And as always, guys, if this is your first time joining us, please go ahead and subscribe to the channel. It really helps us grow and spread word about the honest money revolution that we're building right here on AGX Media. So Dan, I read with great interest your latest article on the fourth revolution. Tell us about your thesis of these things here to come for the economy. What does this fourth revolution look like?
Yeah, so quickly, and it's all in the article if you want the details, but the first revolution was a revolution about the individual. It was about Enlightenment ideas and devolving power from a centralized king, a centralized authority, to the states and really to the people. The second revolution was the Civil War, and people don't think of it that way, but in my view, it wasn't really about slavery. It was about states' rights, and states lost their rights. National power became preeminent in politics, in the court, and also in economics. The Washington printed greenbacks, fiat currency, which funded the war. They also grabbed centralized control of money and banking. So the individual is still free to act within that context as a free person, but again, these big authorities took control of the rules of the game. The third revolution, in my view, was basically the period from FDR to Johnson, the Great Society. And in that revolution, the government itself became the primary economic motivator. The individual was subsumed into a secular religion. Christianity started to wither, and you still have your own opinions, but again, the great economic forces, the Keynesians, would define how you act within a macroeconomic and political context that the leaders, the neoliberal, or whatever you want to call it, controlled. The fourth revolution, in my view, is ongoing right now, and it's the Marxist revolution, essentially, where the individual loses all his remaining freedoms. What you think, what you say, how you act, how you behave economically are proposing to be directly controlled by the state. I mean, think about First Amendment rights. That's something every school child learns, but the reality is that you can define a hate crime to be almost anything. I mean, hate crime is when you say something someone else doesn't like. Well, I mean, that's not the First Amendment anymore, and that's where the left wing is taking us. And so it's again, money and banking, same thing. MMT. It's about removing any discretion by the individual to behave and think as he wants to.
Very, very insightful, Dan. Thank you so much. Now, you've told us a lot about how this fourth revolution is looking, where it comes from, and some of the key players that stimulated this revolution, were sort of catalysts, if you will. Now, how do we prepare for it? Which monetary instruments will best guide us through all of it? Is it silver, gold, cryptos? I'd love to get your insights here.
Yeah, so one of the things that emerging totalitarian states do is obviously want to control money and credit, because that gives them economic power. I mentioned on a call I was at recently with some senior central bank officials who were talking about cryptocurrencies, that Vladimir Lenin wrote that a big bank was essential for the operation of a socialist economy because it had branches in every town, and then the commissars could see all the economic transactions. Right. This is what Fed coin is promising. The Federal Reserve has this idea of having a Fed coin, a digital currency that would allow them to have negative interest rates because you couldn't escape. This says you can't withdraw money the way you can at a bank, and also it would allow them to track every single transaction. And again, for me, you can view these proposals in historical context. When you go back and look at totalitarian governments, whether it's Nero or Diocletian or Robespierre or Hitler or Mussolini or any number of people like that, or frankly Roosevelt, right? They don't like the idea of free money, because when you have free money, it means that people control interest rates, because they can take their gold out of banks and out of banks. That controls what the banks can do with it. It controls economic liberty. In fact, I'm sure your viewers may be aware that Warren Buffett's father, Howard Buffett, wrote a wonderful article talking about how gold money was essentially intertwined with individual liberty. And so the first thing a totalitarian government has to do is get rid of gold and have a fiat currency to control people. Now, the leaders I just mentioned made holding gold very dire. Diocletian was a capital offense. I think Robespierre made it 7 years in irons, and FDR made it 10 years in prison with a $10,000 fine. So they really don't want you having gold. You're in prison for a long time. Well, that's a pretty good sign that maybe you should have some. Gold is free market money. Gold and silver are free market money. They emerge out of the market naturally because of their liquidity profiles. This was all written up by Carl Menger, who was the founder of the Austin School of Economics. I think the trickier thing is not wondering what money you should have in this emerging Marxist wave that we're experiencing, which may not succeed, by the way. I haven't given up all hope on that. But it is that, again, they make it illegal to have gold. I don't think that the U.S. is approaching the place yet where we're going to go full Bolshevik and they're going to shoot you and take your gold. I just don't think so. And what else could they do? Well, they could try to bring a transaction tax on us. They immobilize the gold so you have it and it's in your basement. No one knows about it. That hasn't worked in the past. In fact, Salmon Chase, the Secretary of the Treasury under Lincoln, tried that. The greenbacks, as I mentioned, issued for the Civil War depreciated almost immediately, and so they wanted to get rid of gold out of the system. So he put a transfer tax on it, and then he made trading gold illegal. And what happened was the greenbacks completely collapsed. The reason that didn't happen when FDR tried it, did it, was because the Federal Reserve was actually very solid. That the dollar was backed by mostly gold bullion, and Andrew Mellon paid off most of the federal debt, and so it was actually a very solid instrument, which is why it didn't collapse when Roosevelt did that. So, but the deeper point is that I think holding gold is still a viable option for the foreseeable future, especially the next 4 years. It looks like whatever happens to the presidency, the Republicans have hung on to the Senate, and so I think we won't see any super duper crazy things coming out of Washington for the next 4 years. Bad things, yes, but not crazy things yet. So I think that's a pretty safe bet.
Absolutely. So I'm loving the fact that you're a big believer in precious metals. Can really hear it in the way that you talk about silver and gold, and some of the common pitfalls of things like hiding it or stuffing it under your mattress. What are your thoughts on the rise of commodity-backed assets, blockchain assets that are backed by things like gold and silver, an initiative to return sort of silver and gold to a state of being honest money, as you will?
I think it's entirely driven by the market. It makes perfect sense. Gold itself is very illiquid physically, and what I mean by that is when you think about economies in the Middle Ages where you had to go to a market with gold coins, and every coin is a little bit different, and so the merchant has to weigh the goods he's selling to you and also the coin you're tendering in payment. Well, that's a pain. And so what the first banks did, what their function was to add liquidity to gold. And what that means is you deposit your gold coin at the bank, they weigh and assay it, they find out how much gold you actually have, and they issue a receipt for it, a piece of paper that says you have so much gold at the bank. And merchants prefer that receipt for gold because they know precisely how much gold it is, and they know they can go get it anytime from the bank. And so that is the origins of banking. And of course, as we know, all banking systems start that way, by the way. They start with issuing money and credit against gold, and then there's some crisis, a war or revolution or something, and the great leader cancels the ability to redeem your gold. But the point is, this is a natural process. And in the 19th century in this country, individual banks could and did issue their own currency against gold money. And again, the market worked very well. The further these notes wandered from the bank that's issuing it, or the less solid they were, the more the market rejected them. It's called the law of reflux. So what happened is, let's say a bank receives a gold deposit, issues a note, and the market's worried about whether the bank really is solid or not. Well, the note will start to decline in value in the market, and you can take that note, you can run back to the bank and redeem it, get your gold back. And so the bank's been playing fast and loose with its operations. The gold starts to flow out of the bank, and in those days, if the bank had lost all the money, they were personally liable for all the bank's debts, which I think is a great system. They should bring it back. And so again, this is a legitimate function, and the way I see the crypto revolution going is down these lines, where cryptocurrencies can represent perfect amounts of gold and silver and add liquidity to those elements. I'm very skeptical of Bitcoin, because Bitcoin it's self-referential, and I've read a paper on this. I'm happy to discuss if you like, but it's not backed by anything, and because of that, it's enormously volatile, and volatility makes really bad money. Whereas if you have a trustworthy custodian and you have very liquid things that represent that custodian, what is holding the gold, that is what money is all about. And I'll just add one more point, which is George Gilder is the fellow who's written really well on this. Gilder talks about the noise to signal ratio, and usually he means that in telecommunications. So if you send a signal down a copper wire, copper is somewhat volatile. So there's a lot of noise. You can only fit so much information down that copper wire before you lose the signal because of the noise. A fiber optic cable has no volatility. And so as a result, that's why you can squish so much information down it, because there's so little noise, the signal comes through clearly. And his analogy is that when you have a currency like gold that is sort of really dumb, right? It's really not volatile. It's value stable, it's supply stable. Mining only has 1.5% of the above ground supply every year. What it means is that you can squish information. It transmits prices, and you can the less volatile your medium is, the more information about prices you can transmit through it. Whereas people talk about how wonderful technology is and Bitcoin, those things. Well, that creates enormous volatility. And innovation does, which is great for most things, but in your money, you don't want that. You want the dumb medium that is not volatile, that can transmit prices, and that's what money's function is supposed to be.
Absolutely, couldn't agree more. In fact, the project that sponsors this channel here, its whole initiative is about restoring gold and silver to their historic place as money, using blockchain technology as the vehicle to make that happen. So I'm really glad to hear that you're in line with sort of our ethos and our way of thinking, what we feel good money should be. So I have one last question for you. I saw you once had $3,000 as a forecast for gold, but you recently upped it to 10,000. Why the big boost here?
Okay, well, so let's go back a little bit. A lot of commentators, even those who are pro-gold, said you really can't put a value in gold. There's no cash flow, so you can't buy it on that basis. It doesn't have any industrial use, so how do you do it? And again, this is what makes it such good money, because it doesn't have those attributes, and so it's not affected by the business cycle. But I disagree with that, and the reason I disagree is because that you can't put a price on it, a price target, and that is because once you've accepted that gold is free market money, and again, that can be an hour conversation of itself, but the basic thesis is that gold, that in a state of barter, you want to reduce transaction costs, and what money really is it enables barter to happen more efficiently, and that immediate good, this is what Carl Menger talked about, the thing you trade your good for, in order to trade that thing for the next thing you want. That's what's immediate good. You want it to have the least transaction costs possible. And so the market naturally gravitates to wheat first, look back in history, and then copper as it became available, then silver, and then gold. And so the market goes to those things, those elements, to be best money for particular reasons. So once you've accepted that, then you can look at the dollar and say, well, what is the dollar? Well, the dollar, as we all know, we should know, was the first currency act of 1792, defined as a certain number of grams of silver. And then through the 19th century, that definition was tweaked a little bit, I mean, here and there, to gold, and it was more or less the same value. But what it has turned into is a unit of liability of the Federal Reserve. That's what it is. And what it should be, that's what it is. And so the Federal Reserve is a bank. It's got a balance sheet. It has assets and liabilities. And again, we know what the liabilities are. Each one is $1. And what are its assets? And if you look at the history of the Federal Reserve, when it began in 1914, it had mostly gold on its books. And then its purpose was to actually liquefy not just gold coins, as I described earlier, that has been going on since the Middle Ages and even before, but also commercial credits. I don't mean loans to companies. I mean companies that would sell things and have invoices, trade invoices, and they would go discount that at the Federal Reserve. So that was its primary purpose. So its assets were 90-day commercial paper, meaning invoices, and gold. They started buying government bonds or sponsoring government bonds to fight World War I. So almost immediately after it was founded, they started doing that. And as history progresses, and I've got a chart of this in my materials, you see not just the quantity, the size of the assets going higher, but more importantly, you see that the percentage of holdings start changing. So the Fed has no commercial debt anymore. I mean, commercial invoices, it all became government bonds. And at first it was only 6-month government bonds, and it was 2-year government bonds. Well, now they're buying 30-year government bonds, right? Well, a 30-year government bond is a really dangerous thing to own, because it's a fixed rate bond, and the longer a bond is, the more duration risk you have. When rates change, it has an outsized influence on the value. Then in 2008, they started buying really crazy mortgage-backed securities. And those things are very strange, because as yields fall. As interest rates fall, people refinance their mortgage, so your duration goes down. And as yields go up, no one refinances, so your duration goes up. So they're really, really, really toxic things for a central bank to own. Well, now what are they doing? Now they, even though it's against the law, they create special purpose vehicles with the treasury to buy corporate debt. And some of the debt they're buying is actually subprime corporate debt. And so the point is the composition of what the Fed owns is getting worse and worse. And this all goes back to, again, how do you value the dollar? Now, once you accept it, assuming you accept gold as free market money, right, the way I look at it is, at what price does gold have to be to balance the Fed's books, to make their assets worth their liabilities? And that number, again, you can look, I mean, the data is all public. In 1944, the Great Depression, the Federal Reserve was backed by 84% gold. So its liabilities, the dollar was essentially 84% gold and 16% federal debt, other things. That number got down to 12% in 1968 after the Keynesians took over, used the Federal Reserve to manipulate the economy. And that was the top of that bubble. In my view, what happened in the 70s, and gold went up a lot, it wasn't just inflation, just this amorphous idea. What that did was, as the price went up, it made the Federal Reserve gold worth more. And by the time you hit 1980, when gold passed $650 an ounce going north, the Federal Reserve's liabilities were 100% backed by gold. So the politicians, not the economists, they don't understand this. The market had put us back in our gold standard. Every dollar you walked around their pocket was 100% backed by gold at that price, right? And then the monarchists took over. They're just Keynesians, they're different flavor. They printed the money over the last 40 years, and that ratio of what gold backs the currency by, the Federal Reserve by, has gone down to about 6%. And recently, the Federal Reserve, of course, doubled its balance sheet again. So it was creeping up towards more like 10%, and it went down to about 5%. And now the price is going up, so that number is going up again. If you look back at the last 400 years of history at the Federal Reserve and the Bank of England, the market has insisted at around a 1/3 backing, even in normal times. That was even when the Bank of England and the Fed were buying, again, 90-day commercial credit and short-term government bonds of solvent countries. And so I think 1/3 is a good market level. I think it's a bad level for us now because our assets are much, much worse than they were 50 years ago, 100 years ago, 400 years ago. So the number has to be correspondingly higher. And again, in 1980, it hit 100%. And I haven't checked recently, but that number is up in the $25,000 an ounce range. That wasn't an equilibrium price, but that's how crazy you can get in a credit collapse. And I'll leave the conversation with one thought, which is in the pre-1930s, anyone could take a currency note and run it to the prospective central bank and redeem it. So you go to the Bank of England, you go to the Bank of Germany, you go to the bank in Austria and get your gold out. Obviously, you can't do that anymore. But you can still go to a coin shop and say, I don't want this thing. I want to buy gold. That boosts the price. And again, once the price of gold gets to a place that balances the Fed's balance sheet, then that is how a credit bubble is resolved. That's what a run on the Fed will look like, is gold price going to a place that balances its books. And that number today, again, if you operate on 1/3, you're up at 8,000. Okay, and I don't think 1/3 is the right number because I don't think the Fed's assets are as solid as I know that they're not as solid as they were when that number applied. So I think we're looking at 10 in a panic and could be a lot higher than that.
Dan, once again, thank you so much for joining us. To the audience today, if you'd like to read more about Dan's work, check out his newsletter, Myrmikan Capital. Thank you once again, Dan, and take care.
Thanks for having me.
And as always, guys, if this is your first time joining us, please hit subscribe. If you like what you saw here today, your engagement helps us grow and spread the word about the honest money revolution. Take care.